Hi, everyone. Thank you for joining today's webinar, Live Risk Model Tearsheet Review with Dr. Jess Stauth. Today, she will be reviewing the tearsheets that our users submitted and assessing how the algorithms measure up against the Quantopian allocation process, as well as giving suggestions on how to manage risk exposure using the new Quantopian Risk Model. So Dr. Jessica Stauth is Quantopian's Managing Director of Research at Quantopian. Jess and her team are in charge of selecting the algorithms from the Quantopian community for our portfolio. Previously, she has worked as an equity quant analyst at the Starmine Corporation and as a director of quant product strategy for Thomson Reuters prior to joining Quantopian in August 2013. She holds a PhD from UC Berkeley in biophysics. Just a reminder, this webinar is being recorded and will be available to watch on our website within the next day or so. Thanks, Jess.
Okay, thank you, Paige. So I'm going to try to share my screen here, and to correct for my prior mistakes, if one of you guys can let me know that you can see my screen, that would be helpful.
We can see your screen.
Fantastic. Okay, cool. So first of all, thanks folks on the phone for joining, and especially big thanks to the brave souls who published their ideas for trading strategies, or at least toy models for trading strategies, and shared them with us to review today. So that's awesome. I really appreciate it. And I planned to try to go through, I think, 3 or 4 tear sheets, depending on how much time, and sort of questions we take going through them. So feel free to submit questions while I'm talking and running through these, and my plan will be to sort of either try to respond in real time, or if it makes sense, or to pause between each algo that I've gone through and try to answer questions. So the quick high-level context, which presumably you guys know because you found out about this webinar and came, the idea was to sort of just take some real-world examples of some trading strategies that you folks in the community have created on Quantopian, and take a look at the results of running your trading strategies data exhaust through this risk model that we've built and made available on the platform over the course of, we've been building it over the course of the last few months and made available in the last couple of weeks, and to sort of talk through how we're internally thinking about interpreting the results of using the risk model to decompose algorithm performance, and think about sort of validating your hypotheses about why your algorithm makes money, for one, and then also making yourself aware of what risks you may be either intentionally or unintentionally being exposed to, and how to make use of that data. So the first one I thought we could go through is this free cash flow yield strategy. So I'm going to give my quick sort of intro overview to what I understood about it, and I think the author of the strategy is on the call, so then I'll try to see if I can use the technology at my disposal to unmute him and see if he wants to walk us through his thinking process a little bit, and then I think I come up with some questions for him as I go through the tear sheet. So I like the long-time lurker. It's like long-time listener, first-time caller. So Ben put together a free cash flow yield strategy, which is really cool, right? It takes a fundamental, it takes a field out of the Morningstar fundamental database. So I sort of went and double checked, and I think if you look at the source code, he's grabbing this free cash flow yield latest ranked out of the Morningstar fundamentals database. So the first question I had that we'll come back to later is, this is a pre-computed field in Morningstar. And so one thing I think is that it may only be updating quarterly when Morningstar is updating results for each company. And so it might be possible to just get a free cash flow numerator and then have a live price denominator. You have a signal that might be moving around a little bit more during the quarter. So what Ben's done is to go back to his nice summary, take the sort of top liquid 1,500 tradable universe that Quantopian provides, use this free cash flow yield piece of data to rank those stocks from sort of, I guess, most to least, I think, and then go long the top quintile and short the bottom quintile. So I think that means he's going to end up with about 300 positions on either side. And then he's going to rebalance this strategy once each week. And so when you look at that back test, it looks really quite nice. Oh yeah, then there's your like 300 names aside, and you have a nice, leverage targeted kind of around one. Who knows, something happens here. Maybe the universe rolled over. So the leverage is really well controlled. So let's jump into looking at the performance analysis. So Dan threw the trading strategy into this nice notebook where you, for those of you who may not be sort of experts in the research platform, this is an incredibly powerful tool. So you're really getting access to sort of the same tooling that we use internally to evaluate strategies. We use an internal Jupyter notebook environment, and we have this sort of programmatic and at scale, but same idea. We reference backtest IDs like you have access to about your own algos in the system, and then we run tear sheets just like these. So let's take a look before we dive into the risk characteristics. Let's just take a look at sort of the basic summary stats that we would have had before the risk model, and take a look at how this looks. So we can see we have like a nice long back test of 164 months of data. Of course, it's all in sample. So one thing I think I'm excited about seeing us make easier down the line is give you guys some more tools to be able to separate sort of holdout validation data, right? Because now we have this idea that free cash flow yield works well. We've run this back test that covers, sort of this, relatively close to our full sample of data. And I saw that Ben was wondering, oh, hey, my strategy is not performing that well in the last year. Why might that be? And those things become like trickier to disentangle, I think, a little bit when you run over kind of a full set of data. Nonetheless, the returns look nice. So this is unlevered. So this looks really good. The Sharp looks really good, right? It's, well over 1, close to 2. That's great. On, unit leverage. The turnover is probably like low, but to be expected for this type of strategy. That comes back to like, I have a feeling maybe this data point that's being used to do the ranking is only updating quarterly. Although I say that, I'm not sure. And when we look at the turnover and the trading portion of the analysis, we might be able to see that. And then, of course, what's coolest is this prior version of a single factor model that we had, right, where you just regress out the market beta and see what alpha is left over. That already looks promising. Of if you sort of came out with saying you think you have 6% alpha a year, you would feel happy about that. So the equity curve looks nice. Of course, you definitely have some time periods where there's some drawdowns, but if you look at the depth of the drawdowns, they're very manageable, even if you were to lever the strategy. Of course, if you look at the length of the drawdowns, some of them definitely are substantial, but that's really pretty expected, I think, with a kind of value or sort of a type of value strategy. All right, so then here we can see nice, our single factor beta to SPY looks really well controlled. Our volatility looks really consistent. I like looking at these rolling charts just because then I get a sense of, how variable are these measures over time, where you're otherwise kind of using a point estimate. And so like we pointed out, there's definitely some rough patches, and definitely the last 6 months, or I guess even kind of a year, has been more challenging for this strategy. Let's see, were there any other plots I wanted to go over here? Right, so I always really do like looking at the calendarized returns and sort of just seeing what's the consistency of the performance of a strategy sort of across months and years. So you can scan down across the annual returns and say, oh yeah, wow, didn't have a good year in 2007, and then this is really the first down year in 2017. So that would be, something that might potentially be concerning. And I think below here, we've got some of the, so, nice in that you've got, fairly small position concentration. Although one question I will have for Ben is in terms of the turnover. Oh, right, I have another version where I skipped below all that, I think. Yeah. So one question that I have too is, so here nicely we see our net exposure is pretty close to 0 and it's well managed, so that's nice. We are not taking a lot of risk in terms of being net long or net short the market on a dollar basis. Then I was looking at the portfolio allocation over time. So this plot just happens to grab sort of across all time what were the top 10 largest holdings. And definitely you can see that there's some large holdings that are sort of getting into the portfolio and really don't look like they're particularly being rebalanced and sticking around for a long period of time. And so that might tell us something about what's the autocorrelation of this alpha signal or this ranking. That's something that might be interesting to look at in the Alpha Lens library separately in the research environment, because I have a feeling maybe it's like really low turnover signal. Then something weird happens that I don't totally know what it is, but it could be driven by our universe. So we go along with like a pretty consistent total portfolio size, and then something happens right before the beginning of 2016 where we get sort of a step change and go up to 600 positions. This might be a thing to do with our universe, but I'd want to sort of check into that. So we're holding equal number of longs and shorts. That's great, and that we expect that. Leverage is being targeted and managed pretty close to 1. Right, and so here again, we can see something is happening that's a little bit of either a regime change or I'm not sure what, where our rebalance, so this plot shows your turnover by day across time. And so I noticed that it seems like there's sort of more turnover in the last 2 years. So the peaks are lower, but if the strategy is rebalancing, I guess, weekly, it looks like in the past, maybe you were getting like, I can't tell exactly how many big rebalances, and now you're getting like a lot more smaller rebalances. And so I'm not sure what would be driving that. The trade time distribution. So this looks like Ben's probably doing something where he's starting trading in the morning and he's letting it trade over some time window, which is cool. But, definitely that's something I think we're interested to talk with people more and more about is, for a strategy like this that's turning over so infrequently, you may not necessarily need to trade it in the morning. It might be interesting to try trading it in the last hour or two of the day. There's a lot of volume, but really wide spreads in the first half hour of the day, or certainly the first minute and then out through half hour. And there's much tighter spreads, and it's a little more efficient usually, depending on the strategy, to trade at the end of the day. So now we get into the cool new stuff that we didn't have before, which is the output of our attribution analysis. So let's just talk for a second about the summary stats in the top plot here. So nice little, short set of summary stats. What's our annualized specific return? So remember back the very kind of first plot that I showed, we had about 6% alpha if we just regressed out the market beta to SPY. So this is a pretty nice result. We have about 5.35% alpha. So that says really there wasn't a lot of risk that we attribute to any of the other of these 16 factors in our model. So the common return ends up being a pretty low annualized number. And the other thing that's nice to see is the specific Sharpe ratio. So this is the Sharpe ratio, or the mean over the standard deviation of the specific returns time series. So if you sort of imagine that you have an equity curve and you've taken out all the returns due to common risk factors, what you've got left, that time series has a Sharpe of over 2. Well, that's a nice result. So this exposure summary table, in kind of prepping to walk you guys through this spreadsheet, I went over, or this analysis, I went over this table with Renee, who built the model. And her way of thinking about kind of how to use this table today as it exists is to sort of scan down and just look for, large numbers or kind of outliers. And she pointed out, this is the average over this time series. So it, like all averages, can be helpful or can be a little bit misleading if it might look reasonable, but there might be time periods that are sort of above trend or below trend. So if we just sort of scan down, there's not really particularly a lot of exposure to any of the sectors, most of the styles, and then you sort of see pop up, there's a positive exposure to size, meaning the strategy, at least at some times or on average, is going to be predisposed to buy large cap stocks over small cap stocks a bit. And then the other larger one is really, I think, kind of goes hand in hand with this, which is a bit short volatility exposure. So these two factors, I think, do end up picking up some correlated risk where, if you're long a bunch of large cap stocks and short a bunch of small cap stocks, then if you look at how volatile are the stocks in your long and short book, the small cap stocks might tend to be more volatile than the large cap stocks. And so you might see a positive exposure to size and a negative exposure to volatility. So why don't you see really any exposure on average to value when I'm telling you, this is sort of a value strategy? So I'll get into that as I scroll down here. So let's just pause and look at, this is our old friend, our cumulative returns equity curve. But in the past, right, you've always just focused on this total returns, which is shown here in blue. And now you have the ability to sort of pull out and attribute out this common returns, which in this strategy ends up looking, really quite modest. And you can see, oh yeah, look, this is great. Now the way I would interpret this, especially since Ben has been kind enough to share with us, exactly what his strategy is doing. So I would think of this as, these are returns that are not explained by the Quantopian risk model. So does that mean that there's no exposure to, different sort of quote unquote common risk factors? Well, no, we know what the exposure is to. It's to this free cash flow yield. So depending on, how you wanted to think about this strategy, you could say, hey, I want to create like a separate risk factor that's just free cash flow yield. And I'm going to put that in my risk model. And I'm going to look and see, pretend I don't know sort of how simple this strategy is. I'm going to look to see if someone's been able to create a strategy that's, better than just vanilla free cash flow yield. So that's something that you could look at and could think about. All right, so then down here, we've got currently sort of two other ways of visualizing the returns generated or attributed to these factors in our model, right? So over here, you've got your sector factors at the top, healthcare, energy, consumer cyclical utilities, consumer defensive technology, communication, real estate, basic materials, and industrials, financial. So I guess this is sorted on who knows what. So the style factors are kind of sorted within here. So there's size, it's orange, not that you can necessarily read when there's so much data in this plot. There's value, there's vol, there's what's left over, the residuals, and here's momentum. What I like for this daily plot, although we've been debating a bunch internally about, sort of how much we think it's going to still deserve space in the Tearsheet, I like that it kind of just shows you if there's any days on which you have a really big spike in returns attributed to some specific factor. But obviously, when you're overlaying all of these, you get sort of like an enveloping effect. So it's not as if you can necessarily really tell. So I think we're working on a plot that shows this cumulative as well, which helps a little bit. So now what are our daily risk factor exposures, right? So above, we looked at that summary table, which said, oh, hey, on average, our highest exposure was positively to size, which is here in green, and you can see that here, and then negatively to volatility, and you can see that here in sort of this light blue. And you can kind of see that thing I was talking about, that the way we've constructed this, and for this strategy at least, being long large cap stocks sort of has that mirroring image of being short volatility. So what, when Renee and I were reviewing this, and actually it's funny, someone internally on our team had used a free cash flow yield as an example strategy to sort of test and put the risk model through the paces. And so what we thought makes sense about this is, hey, it's a value-ish type strategy, but it's not actually identical to the value factor that we put into our model, which more looks at the book to price sort of relationship. And so since it's a little bit different, okay, it doesn't exactly track with our book to price factor, but hey, you can still see that it's taking on exposures to size and volatility. So if we added a free cash flow yield factor, then presumably we'd be able to pick that up really nicely. All right, so why don't I pause there? I'm going to see if I can unmute Ben. All right, let's see if that worked. Ben, can you try saying something if you want to?
Hello.
Hey, we can hear you.
Brilliant.
Awesome. So thanks for submitting a strategy. We really appreciate it. So I'd love to hear, I guess the questions I had were sort of like, number one, if you had looked at all at like the how your ranking is turning over with time, if if that data point just updates quarterly. And then I guess, yeah, if you had any other questions or sort of, anything else you wanted to talk about it.
Yeah, looking back, I think what's happening is, I think maybe the Morningstar database, the frequency of the updates changed in around 2016. That's what.
Oh, you think so? Okay. So
sure. I might not be correct. I mean, this really was just sort of the first stab at something, and thought, seeing as I got lucky, I thought I should share it because it's so simple. And
Yeah, absolutely.
Seems to work. It seems to have worked reasonably well at different points in the past. I think. Well, I don't know what you would suggest in terms of refining it. Obviously, without overfitting. I mean, I was thinking of combining factors or something, but
well, yeah, exactly. So I'd say like, so now you have, so first of all, one thing I might try is, since this is like lends itself to being such a nice, simple standalone factor, right? It's like, one field out of the Morningstar database. I don't know if you've checked out the AlphaLens library. So that's really like well designed for being able to just look at what's the predictive quality, like ranking quality of this one factor. And you don't necessarily have to mess with like, what time of day are you trading it? And that's in the research environment. So I would probably throw it in there and say, what's the information coefficient of it? And then, you could start to say like, well, what would I want to combine it with other factors that, are not correlated with it? And I think my advice, I've been talking to a bunch of colleagues about this around like, as we're thinking about how to help people with, dangers of overfitting and holding out data. And one of my friends was saying he holds out the last 4 years of data from his model development period, like for all of his research. And then at the very end, when he's going to deploy a new factor or signal, he checks it. Now that is probably like not the right advice, one size fits all. We had sort of been thinking about like a trailing 6 months, but definitely if you want to sort of start playing around with other factors and combining them, I would decide on sort of, for now, what's your rubric going to be for holding some data out. And then that way, when you sort of have something you want to check, you can, look at your validation data. And that's usually pretty enlightening, I would say.
That sounds good. I mean, I actually found it using AlphaLens. Actually, I found this factor. That's how I figured.
Cool.
Yeah, so I've been playing around with that over the last couple of days, trying to find something complementary. But one question I wanted to ask is, I guess, seeing as you at Quantopian have all this, you have all the data, right? And I guess you have the sort of computing power, or at least, I mean, at least you have the personnel. I mean, have you essentially run every factor in your, let's say, in the Morningstar database and in all the databases that you have? Have you not just run them all through AlphaLens?
I think that we have. So the way I would think of it, so typically I think like, while not to say that we have, definitely someone has, right? So I think the way that we think about it is, well, I guess it depends what perspective you're asking from. So one thing is sort of when we put new data sets on the platform, like, do we evaluate those and sort of say like, you have a signal, like, what does it look like? We do tend to do more of that in terms of saying like, hey, can we show people, if this new data set field XYZ has something that might be there to it. I don't think we've sort of systematically gone through and said like, hey, what do we think about every single individual Morningstar field? Because I guarantee you, like, some will look great and many will look crappy. And the problem is that the devil is all in the details of designing the strategy of, what fields to use when in combination with what other fields, and sort of how to put a little bit more creativity into it for that. And with that, we've really thought about, leaving that work to the community and sort of trying to give them good examples and guide them, but sort of not go, entirely define the search space for them and say, hey, here's like the answer key. This is what we want you to do.
Yeah, because it seems like though with, you've done a lot of content about, looking for factors and using this kind of factor ranking method. So I just thought, I guess someone somewhere with the computing skills, I definitely don't have them yet, but someone could just essentially use your Tearsheet for every factor that you have, and then overlay that with something to essentially pick the best combination of them. Then you have the best factor.
Yeah, and honestly, that's a pretty like traditional way that like sort of a proper large quant firm would do this. They would maybe not take the identical fields right out of the database, but they would basically take fields and adjust them, do whatever they think is right to make like, one of, let's say, 400 factors. And then I've seen people build models where they like do machine learning to weight those factors differently across time. So things like that can definitely work. I think we have not explicitly gone after sort of enabling people to do that, like check every single factor, because I think we're a little bit worried about data mining there, and we're sort of more interested in folks coming in with like a little bit more hypothesis driven and try to find more niche strategies. So as I'm saying this, I see another like Quantopian community member who I know chiming in with some good suggestions in terms of what you might want to look at to sort of be complementary to a strategy like this. And his point is that something like a momentum or a price or earnings driven strategy would probably be like a good counterpart. And I think that would sort of probably be the classical advice you would get if you want to look at trying to improve it and maybe smooth out some of these drawdowns a little bit.
Yeah, because I guess that would hedge out the short vol component at least. Yeah.
Yep.
Good. All right. Well, thanks very much.
Yeah, cool. All right. Well, thanks so much for hopping on. So I'm going to mute you again. No offense. Feel free to chime in.
None taken.
All right, cool. So let me just look. I think we also have, I see Alan. So Alan, I'm going to do your strategy next because I don't see James, who's the other person that I have, and so you're online. So we'll start with you. Okay, so Alan submitted his Tearsheet, and I've got it in a little bit of a different format. So hopefully this is still going to be visible to you guys. Okay, so I'm going by the name up here. So actually, maybe I should unmute you now, Alan, so you can sort of maybe explain if I'm right about guessing. Alan, can you try talking?
Hello.
Hey, how's it going?
Good.
Cool. Thanks for submitting something, and thanks for hopping on to chat about it.
No problem.
So I'm reading that. Yeah. Well, no, I think this should be painless. So I'm going from, I don't know if you had sent us any context, but I'm guessing this means like machine learning, something optimized pairs, maybe?
Yeah, the pairs never got added in, but the other stuff is in there, right?
Okay.
Machine learning and the optimizer, pretty much with a bunch of factors.
With a bunch of factors. Oh, all right, cool. Okay, so, all right, so I took a look at the summary stats. So again, kind of just saying, well, how would you review this tear sheet and think about it before you even looked at the risk exposures? So the Sharp looks good. The drawdowns look nice and small. So probably just skimming down, like the first thing that I think of was that it's turning over a lot each day. So then as we go look at, whether we are estimating costs or thinking about that, it's definitely turning over on the higher side, which probably makes sense because you're doing something that's maybe turning over your signal a fair amount. So then the equity curve, right, like looks good, but I guess it's like very much got some regime-y stuff. Like it's got like a really nice run and then a really flat section. So it's tough over this time range probably to tell. And I guess same question to you would be, or not question, but advice would be to, in the interim while we work on trying to get you guys better tools for making it easy to hold out data, I'd continue to suggest that, unless you may be already doing that on your own. All right, so let me see.
So by hold out data, you mean do it up to a certain time period and then see how it does on the time period where you held out the data?
Exactly. There's a lot of different ways you can do it. And so we've been sort of like struggling with thinking about like how to enable this on the platform and make it sort of a best practice and easier. So one way, like if you think about the way we're trying to do this with our selection process, we're sort of assuming you guys aren't using any holdout data. And so then we're saying we want to see, 6 months later that's like true out of sample data and what strategies sort of survive over that time range. And I think one challenging thing is like, depending on how much turnover there is and like, regimes move however they move, you can't really necessarily capture that. is that enough time? And so what you can do is basically hold additional data out for yourself to then go back and check against. And you can do that in any way you can imagine, sort of like kind of a little bit of a personal preference. The research shop that I used to work for, we would hold out like every other year and then some subset of months, so that we would have like held out data across a wide time range. But then you can definitely also just do something simpler and hold out, the last, whatever, 6 months, 1 year, 2 year. What's tricky is, of course, once you've sort of formulated your strategy and then looked at your holdout data, if it doesn't look good, like, what are you going to do? You're going to go back and keep working on it. And so you definitely have to be careful with that full loop, kind of how you think about that. All right, so let's skip ahead here. 1 second. So let's skip ahead so again, we can see what's nice right there, small position concentration, and that's something I think is definitely really important. Okay, cool. So long exposure and short exposure, just like the last strategy that we reviewed, are equal. So this is nice, right? We know we're not taking dollar exposure. Position concentration, really consistent. The position concentration is consistent on the long and the short side, and we can see like both the max and the medium, and then we can see the number of holdings. So we're like always under 1, and here's where we see that turnover being pretty high. So are you rebalancing this? Like, how often are you like re-updating what your model wants to hold?
Well, I mean, I had two parameters I kind of switched between daily and weekly.
Okay,
and
so this
I can't remember this is the daily one or the weekly one.
It looks like weekly, I'm just guessing, just trying to count like how many, although it's hard to tell. Okay, so
yeah.
So right, so then yeah, like the distribution of turnovers, we can see like, oh, on a lot of days it's not trading, and then like when it does trade, it turns like the whole portfolio over pretty much.
Correct, right.
Yep.
I mean, it doesn't do that by design. It just does that because that's what comes out.
Right, exactly. So one thing would be, what that tells me is that whatever frequency you are trading this at, like let's say you're trading it once a week, if the whole portfolio turns over, that probably means that your signal is moving faster. So on the one hand, like you don't necessarily want to like increase your turnover, but it could be interesting to look at what if you ran your model and rebalanced it every day, what would its like natural turnover frequency be if you did that?
I see, yeah.
Okay, cool. So here we go to the risk exposures. So this one looks like it's realizing more of its returns from common factors, and I guess we'll look and see, and I think I can remember which ones, and less from the specific return. But the good news, of course, although right it's in sample, is that neither of these numbers are like big and negative, which certainly can happen to you. And then here we see, right, so the specific Sharp we had in the last case was like 2, so that's much more consistent than 0.2, and we'll see that when we look at the time series, I think. So scanning down the summary table, right, like where's kind of our big outliers and what pops out right away, and then I think makes sense, although you said you don't have pairs in here, so what pops out right away is it looks like the largest exposure is to short-term reversal. So I don't know if that's consistent with how you would have thought about it, Alan.
I'm a little confused by that, to tell you the truth. The short-term reversal term, I mean, what's the definition of that?
Well, yeah, so good question. We have Renee on the line who built the risk model, so maybe we'll get her to unmute herself. I think it's like a 5-day reversal, but Renee, please hop on and correct me if I'm wrong about that.
So it uses a relative strength index. So the relative strength index computes 14 days gain or loss. So it comes 14. Mm-hmm.
Okay, that's the RSI, right? Yeah. Okay.
Mm-hmm.
So 14 days.
Mm-hmm. Right. So let's go down and kind of look at that over time. And unfortunately, the PDFing like cuts this poor plot kind of right in half. But sorry, I can still read it. No, it's not your fault. So yeah, like what this does look to me is like, okay, the short-term reversal exposure, it's definitely not like a flat line, like it's not completely consistent, but it's always above 0. So this would definitely stand out as whatever strategy you've discovered, it's definitely, picking stocks in a way that has some similarity to that 14-day RSI factor. And then the rest of these, it's hard to read them, but we can go back and look at the averages. They're not, none of the rest of them really looks, well, actually, so that's interesting. So yeah, so this would sort of corroborate. So you've also got, and Renee, what's the time scale again of the momentum? It's longer, right?
Yeah, it is, they call it like a long-term momentum factor. It computes the 11 months returns.
Okay, so there, right. So then, like, that way you've got like, okay, a sign flip and then a pretty different time scale between these momentum and short-term reversal, but you're still having a little bit, your next largest exposure on an average basis is an inverse exposure to that momentum factor.
Okay.
And then you also sent, well, actually, so let's look. So, okay, yeah, like we can kind of see this in the equity curve. The thing that struck me was if you look at the specific returns in green, you have like, I think this is like April or something, January to April. You've got this one time period where you get like a really nice bump in returns across the board and also specific returns. And then you can see why the Sharpe is so low on it. It's positive over the time period, but you have sort of the long flat period. Whereas you're continuing, at least according to our model, you're kind of continuing to make money on, probably that, we'll have better plots coming in the future, but probably you're making that money on the short-term reversal, working for you and exhibiting positive returns over that time range.
Yeah, and I guess the question to you is that bad or is that good?
Yeah, exactly. Great question. That's the question in the industry. So in the way we think about it, like short-term reversal is definitely a factor that over, long time periods and maybe less so recently can sort of be thought of as having like a positive expected value. So in my view, it's like if you're taking common exposures, that can be okay. You want to know you're doing it and you want it to be like intentional within your strategy or at least consistent with the economic rationale. So like when you really don't want to be taking a common risk exposure is when you think you're doing strategy XYZ that exploits some interesting sentiment signal, but really you're just, buying small cap stocks, right? And you don't know that.
Yeah, I mean, the point of what I'm doing here was to get it to a place where then I can take what I get out of it and put it into a pairs kind of thing, right? So, but a pairs thing is going to do a bunch of short-term reversal, isn't it?
Well, that's not, I mean, that's when I was sort of reading your summary, I was assuming that you had kind of baskets of pairs and that was giving you this short-term reversal.
Not yet. I mean, I have a bunch of fairly sophisticated factors, at least compared to the free cash flow one from the last one, but just because you have sophisticated factors doesn't mean they actually work.
Yeah, well, exactly, totally. So I guess to kind of try to wrap that thought up, so we're sort of most tolerant, I think, of short-term reversal. And then also, I think we're still working on kind of exactly nailing down like, well, how tolerant to what exact cutoffs. It's really difficult to say because you're putting these strategies into a big portfolio of a lot of strategies. So one thing that I do like to see is that, look, so it's not exactly pegged to 0.4 all the time. There, if the time series was sort of peaking at 0.4 and minus 0.4 and centered around 0, then you might even like it more because you'd say, oh, well, okay, so it transiently takes on exposures, but it does so in a way that, seems either by, hopefully by design that, okay, the strategy is exploiting something that tells it when it's going to be profitable to be exposed to, this factor or that factor. So something that moves, around and has higher variance and is still making money, that's like a little more encouraging because you feel like, well, it's making more decisions and bets. It's not just, a counterexample would be something where you've got like, let's say that you can go find like a short-term reversal ETF that you just buy and hold, right? And that might give you like, flat 0.8 exposure to short-term reversal all through time. So that would be sort of like the least interesting version, right? Is, okay, you've just like replicated. The way I think of it is like, like Ben said, the last thing is like, we have access to these fields. We don't need to just sort of go look and say, oh, there's a strategy that just like perfectly replicates one of the factors in our risk model. Then that's probably not that interesting. So definitely that it's like doing something other than, just sort of absolute consistent exposure, I think definitely makes it more interesting. And then let's see if we have time. Let me hop, because you sent another one that is more concentrated, right?
Yeah, this is more like the fun one.
Yeah, exactly. So this one looks awesome, especially right here. That looks really, really nice. I always like when there's like a perfect straight line for some period.
I mean, my brother Jeff actually came up with this one, and what it is you kind of take the last one, and instead of doing a massive long short, 200 of this or 100 of this and 100 long, 100 short, you just say, well, what happens if you just choose 2 or 4 of them?
Right. So how does he pick? How does he happen to pick Google, Apple, Facebook, and Microsoft? Because they're large by market cap.
No, see, that's kind of the point, right? In other words, we're doing these massive long short things, and we're getting these universes that are on the positive side and the negative side, and they're being evaluated by all these factors, right? So you get this machine learning factor, and it just basically grades everything according to one number, right? One column. And at the end of the day, though, you just say, well, what if I just took the top one? What if I just put it into the optimizer, your optimizer, and said, I just want 1 on the long and 1 on the short, or 2 on the long and 2 on the short. That's it.
Right.
Okay, so you don't know exactly what you're getting in the sense of it could change fairly dynamically. It doesn't.
Yeah, definitely.
So you're kind of, but the way this works out is for the last 2 years, you just get the FANG stocks, and that's it. Boom.
So it just worked out that way.
Yeah, but there's shorting and longing massively, right, as you go along, because they, according to the factor, they keep changing.
Yeah, no, definitely. And that shows up. So let me skip down to the risk analysis, because I think that kind of shows up, is what I'm guessing is that, so here's size shows up as like mint green on this plot for whatever reason. So I'm guessing that, this big positive and negative size exposure is whenever it's long or short, the largest of those companies, I'm guessing.
I see, okay.
So yeah, like this is not like, definitely this is not a bad idea. And I think then you can kind of see, picked up in the analysis that, okay, there's definitely still, periods at which the specific returns look quite good. So it's choppy, right? Like that's probably the problem is like, well, how are you going to know kind of what regime you're going to enter into?
I mean, you need another signal telling you when to make these bets.
Exactly. Yeah, exactly. And then, from like our standpoint, and I've definitely seen this with the stuff that we've tried so far, there's definitely a huge amount to the concern about sort of position concentration. And so that definitely goes down when you've got a setup where if you really feel like this, you've got something that's co-integrated and it's a pair, then you can get a lot more comfortable with much more position concentration. But what you just risk so much with the position concentration is that, something that's not accounted for in any way, shape, or form by your model happens to one of the companies that you're trading. So be that an earnings event or a news event, that either kind of can in theory or totally can't be predicted. So that would probably be, I guess it would depend. If we, as we're thinking about sort of running our analyses, if we kind of classified this as like a pairs thing, then we'd probably be okay with like a couple pairs and high position concentration. And we have some stuff in our portfolio like that. And I would say that, like, frankly, that's been some of the most consistent, nicely performing stuff in our portfolio. It's just can be, it can be low capacity. Usually often folks are trading pairs that are a lot less liquid than like the FANG stocks. So I definitely think it can be interesting, but, the concerns are sort of like, how consistent those relationships are going to be over time, and then the position concentration. But this definitely is.
I understand. I mean, it's just kind of, it's not only fun, but it also gets you kind of thinking about, oh, okay, well, the top 4 stocks in the market, they're not really moving that much, at least in the current market, and so that's probably one reason why this is happening.
Yeah, right. I mean, yeah, that is interesting. So it would be interesting. Have you tried running this over a longer historical period? Because I'd be curious to see.
No, I haven't. The longer historical periods make sense to me, but they take a long time to run. And what we've been doing is looking at the contest thing. And if it doesn't work for the contest stuff, it's like, well, why run it for another 10 years? I mean, it takes a couple hours.
Yeah, totally. Cool. All right. Well, these were really nice examples. Anything that we didn't talk about that you really wanted to talk about?
No, I just wanted to throw these two in here, and so if in the future these go into pairs and copula kinds of measurements, then from this point on. I mean, in other words, we end up with some stocks, but we need to get some regions where they're either co-integrated or using the new copula methods.
Yep. Very cool. Well, really cool work. Thank you for sharing it with us.
Okay, thanks.
All right, so I'm going to mute you if I can figure out how to do it. Here we go. Okay, so I've got one more strategy by James White, who I don't see, but I do see a couple of James. So I'm going to start going through this, and if this is your strategy, feel free to drop a question in the question box. And I should share, Dan, who keeps sharing nice questions and feedback, is mentioning that he actually holds out the first few years versus the last few years, I think. And then I don't know what GFC means, but he's telling me how he's doing his holdout data. So I definitely think thinking carefully about your holdout data is important. And again, this is one of the things that has been challenging for us to think through. How do we give a nice tool to the community to let you guys sort of follow best practices and hold out more data? So if you have comments or thoughts about that, whether you share them, now in the Q&A bucket or with us over our feedback email address, either of those would be great. All right, so here's Unpopular Stocks. Now with this one, unfortunately, I don't seem to have anything other than the risk analysis. So I'm going to sort of just treat this a little bit like a black box, other than sort of that it describes that it's finding unpopular stocks to invest in. So by now, I think we kind of understand the numbers popping up in these tables. So the risk model is telling us that this strategy's over the time period that it's been evaluated, which hopefully shows us somewhere, is making about 8.5% of returns that are not accounted for by the risk model. So, okay, that seems promising. We don't have a whole bunch of returns attributed to the risk model. And then again, we have this nice consistency where the Sharpe of the specific returns time series is up above 2. So that definitely looks nice. If we look down through this table and you sort of start scanning for like what are the biggest numbers, okay, there's a little bit of financial services exposure, but really the one that leaps out is you've got a big negative volatility exposure and then a little bit of negative short-term reversal. So there's definitely some stuff going on where you've got some exposures. And actually, so that's interesting to me is if you look here, there's some amount of sort of both wins and losses due to your common factor returns. And you do seem to have like some pretty nice consistent returns that are not being generated from the common factors. So that, looks cool, I think, and looks promising. If you look down here at those risk exposures over time, so here really you'll see a little bit what I was kind of talking about on Alan's strategy, where he had this short-term reversal exposure, but it was sort of, oscillating pretty widely between about 0 and 0.4. So the thing that's a little concerning, or maybe could be fixed about this strategy, is that here's your size exposure, here's your volatility exposure, kind of mirroring that, and they're just really super consistent. So to me, since those don't seem to be driving a ton of the returns, it might be interesting to try to look at the strategy and say, okay, what is it that's causing it to be long these large cap stocks and or short these small cap stocks, and possibly you would be able to kind of pull those exposures out without sort of really messing up the alpha exposures, and that I think could be pretty interesting. So that was kind of my main thought on this one, and given that I don't think I have access to sort of seeing what the individual holdings are, I can't sort of complain that it is or isn't exposed too much to single position risk. All right, so with that, I'm going to just pause for a second and check if I have got, oh, great financial crisis. Okay, so let's see. So Dan says he holds out the first few years, last few years. Okay, you hold out the first few years and the last few years, and for positive skewed strategies, you hold out the great financial crisis. So that sounds like a smart way to think about it. All right, so let me just pause here. I'm going to look and see if there are any questions in the question bucket about any of these strategies that I haven't gotten to yet. So this is also your chance, if you've got a question that you haven't asked yet, to go ahead and type that in. Yeah, so let's see. This one is long, so let me read this. I find the average factor exposures are not very useful. Yep, so totally. I think we're working on that. Actually, yeah, okay. So the rolling charts provide more information. I'm struggling to see how to value switching capability that might be created by an algo. Well, let me focus at least maybe a little bit at first on some of the visualizations, because I wanted to just sort of maybe take a couple minutes at the end here to put Renee back in the hot seat. She's been continuing, so Renee built this model over the last couple months, which has really been really amazing to sort of watch that process come together from a research standpoint. And then she's worked really closely with a couple of the engineers on our engineering team to productize it. And then now she's been focused recently on creating these cool performance attribution visualizations and thinking about how to try to make the results interpretable and really useful and actionable. So Renee, did you want to hop on for a second and just talk about, kind of some of the visualizations and the ways you're thinking about adjusting and expanding on some of these plots that we've put in the performance attribution?
Yes, thanks, Jess. So we are currently trying to, so for this, there are 11 sector factors and 5 style factors. It looks quite crowded, and to really view it unless you look very closely. So we are trying to first split the sectors and the styles and then plot them separately, also providing the both the cumulative returns and the daily returns, also providing the ratio between the volatility of common factor returns and the volatility of returns, to understand what portion of your portfolio, your common factor returns in your portfolio returns, and also a lot actually. So also generate a plot with all of your annual factor returns, all of your annual factor volatility, and annual Sharpe ratio. So then you will have us can look at them clearly, especially when you use optimization API to adjust your position, and then you want to say, okay, how this factor exposure work. You can view it in the research platform conveniently. We are trying our best to put all of the information we think are important and also are easier to view. And if you guys have any suggestions, comments about this, you can post it in the community, and we will consider it, and we value your suggestions. Also, Jess and I today just talk about adding our project, adding the transaction cost into applying the transaction cost to the algos. So you will see how the return attributions look like after applying the transaction cost, including the slippage cost and the commission fee. then you will see how the common factor returns changes and the specific returns changes during time after like taking care the transaction cost. Yes, that's what our research team are currently working on. Yeah.
And you didn't say box plot, but Dan said he wants a simple box plot, and I actually think you have a really amazing box plot coming our way, right?
Oh yeah, so Scout introduced it in a post in the community. He showed like a box post, a post. So I think people may know it, but I do like it, and I refer the Scout work in the box plot. Yeah.
Yeah, awesome. Cool. Well, thanks so much for giving us a preview, Renee. So I think that probably covers, hit on hopefully the questions that you guys had, and hopefully this was useful to sort of see how we might be thinking about looking at these analyses on your strategies. So Paige, I think I'm going to hand it back to you to wrap things up for us.
Yep, thanks, Jess. So we're going to wrap up this webinar. Just so you know, we are going to do another one like this in the future in the next few weeks. So if any of you listening think that you want to run your own tier sheet and submit it, definitely start working on that. If you want to learn more about the risk model that just launched, it's at www.quantopian.com/risk-model. And again, this recording will be available hopefully within the next 24 hours or so. It'll be up on our social media and on our website. And thanks everyone for joining. Thanks, Jess.